High risk pre-allocation tokens. That's what we're going to be talking about in this video. Everybody wants to know what is the new crypto on the block that is going to make them millionaires. Anybody that watches this channel by now understands that I'm all about risk diversification, allocation of risk, understanding what a diversified portfolio is. So can you actually put these high risk pre-allocations into a portfolio? If so, how do you do that? Because in this video, guys, it's going to be a wake-up call, and I'm going to show you exactly how many of these things fail, how many of these things are successful, and how you can allocate it within a diversified portfolio to make sure that if that thing goes to zero, you'll be all right. Okay, so let us get the introductions out the way. Firstly, I'm Keith. This is Crypto Bullseye. Let me know in the comments how you're feeling today. How's your portfolio doing, guys? Are you up? Are you down? Are you happy with the spread? And is anything within your portfolio absolutely wrecked your portfolio as a whole just yet? Because that is what we're going to be talking about. Anybody that's new to this channel understands that I'm not about giving you high risk altcoins. I'm all about risk management, portfolio techniques, trading strategies, and helping you self-develop along the way, guys. I've been on a journey of self-development for the last 5 years, and I want to take you, all of you, on that journey of self-development with me. My goal is to teach you everything that I learn, and I keep developing myself every single day until I become financially free. So that was a long-winded way of saying we need to have a diversified portfolio, and you need to ask yourself one question. And in fact, guys, this video is probably going to be more about you asking yourself questions than me telling you things, because it is your portfolio. It is you that needs to understand it. And it's not me that's looking after your portfolio. It is just yourself, guys. Self-development, looking after your own capital, is a strong, powerful thing, but you really need to understand how to do it properly. So what we're going to do is you need to identify and you need to understand how risky the thing is that is in your portfolio. So where do we go? We can go to CoinGecko in this instance. You can go to CoinMarketCap. You can go anywhere which shows the crypto rankings. And this is the important thing. Now, what I want you to think of, guys, is a pie chart. So you've got a pie chart, and we're not talking monetary terms here. We're talking percentage terms. And you need to allocate your risk in accordance with percentage. What do I mean by that? So you've got Bitcoin. Bitcoin's number one as far as the crypto market ranking's concerned, as far as the crypto market cap's concerned. Bitcoin is 1,672,744,780,853 as far as its current market cap's concerned. So Bitcoin's number one. That means Bitcoin is the least risk asset within the crypto market. So that means that the least risk asset should make up a larger part of that portfolio. So just as an example, and I'm not going to give you percentages, just an example, if you've got a portfolio and you want to be risk off within that portfolio, if you've got a diversification of, say, 33% Bitcoin, which is the least risk asset, that means as everything bleeds, either Bitcoin's not going to bleed as hard or Bitcoin's going to outperform the others. So that's going to hold up your portfolio as a whole. Now, imagine you didn't have Bitcoin within that portfolio. Altcoins have been absolutely battered. So by having Bitcoin in the portfolio, what would that have done? It would have made the downside less, and it would have made that portfolio hold up a lot better. So think of it as a pie chart, guys, and think of it as an allocation of risk. The higher the market cap, the lower the risk. The lower the market cap, the higher the risk. So if you've got, for instance, and this is examples, 33% Bitcoin, a third of your portfolio in Bitcoin, and you've got this new shiny object, this pre-launch, it's got pretty much next to nothing market cap, and you think it's going to take over the world because you've seen a couple of influencers saying, don't front run me in the market. Do not front run me on this pre-launch. Now, when you hear that, guys, and I'll probably get hate for this because quite a lot of influencers do say that. When you hear someone say, don't front run me in the market, what they're trying to do is pump and pump and pump. They've already got their allocations in, and then they can capitalize on your pumping. So you're putting the allocation, you're adding to the market cap. They've already got their allocation, guys. Don't fall for anything like that. Use your own mind, use your own common sense. So you've got Ethereum, you've got XRP, you've got BNB. So these are kind of the blue chips within the crypto market, and these are the least risky. So they would make a larger part of your portfolio, as an example. Now you go further down the risk curve. We've seen Bitcoin was over $1 trillion. Go further down the risk curve. Let's go down here. Find out what kind of cryptocurrencies are in here. What kind of volume? No volume at all. Let's just go back one. So maybe like here. So if we go number 5, so this goes up to the top 500. And remember, there's tens of millions out there, guys. So when you're looking at pre-launches, you're looking at cryptos, you're looking at these meme coins on pumped up fun and all that kind of thing. Nearly all of them are pretty much going to go to zero. So if you've got an allocation within your portfolio because you really believe that, 0.5%, 0.7%. If that thing went to zero, your portfolio needs to make sure that it can sustain it. So you look down here, guys, you've got things like Spell. So Spell is number 418 as far as market cap's concerned. 107, guys, 107,609,639. So you can see you go further down the rankings, the market cap's lower, the risk is higher. If the risk is higher, the part of your spread needs to be lower. Guys, if one of these things take off and you've got 0.3, 0.5% of these high risk things within your portfolio, if you had 10 different ones within that fall within that category, suddenly if one of them goes, guys, it'll become 15, 20% of your portfolio, and you need to ask yourself more questions. Am I over allocated in this high risk thing? Do I need to diversify some out of that into lower risk, i.e. Solana, Bitcoin, BNB, AVAX, that kind of thing, guys? So it is a constant management of your portfolio, and understand the lower the market cap, the higher the risk, the less diversification in your portfolio. So what I've done, guys, is I've gone through a couple of different AIs, combined AIs, because this data is not readily available, just to give you an indication, just to give you an example of what the chance is of the cryptocurrencies actually succeeding. So estimated failure rates in the world of pre-launch or ICO cryptocurrencies is challenging because of the definition of failure can vary. Now remember, people say just go to zero. Things don't actually go to zero because somebody's always holding. But when something drops 99%, 98%, 97%, that can be classed as a failed cryptocurrency. So several industry reports and analysis from the ICO boom era suggest that a very high percentage of these projects do not succeed. Here's some key points to consider. Now, remember, guys, there's tens and tens of millions. We were looking at market cap there. We were looking at the top 500. When we looked at the top 500, you're seeing around 500 had pretty much next to nothing market cap. When you go into the millions, guys, and the millions, that market cap is really next to nothing. So you need to be thinking of that. So high failure estimates. Many reports have indicated between 80 and 90% of pre-launches or ICO projects eventually fail. In this context, failure might mean that a project never launches or works correctly, or launches a working product correctly, loses significant value shortly after launch, or fails to gain user or market traction. So these are the main common reasons for failure. So high failure rate is often attributed to a combination of factors, including insufficient or poorly managed funds, overlay ambitious roadmaps and unrealistic promises, lack of regulatory clarity and compliance, technological challenges and poor execution, market saturation and competition, and then in some cases, it says in some cases, guys, in a lot of cases, just outright scams. So it is important, guys, to diversify that portfolio, and that is the reason why. And I might be teaching you to suck eggs, guys. I might be teaching you to suck eggs, but people in this community, I want to be successful. For us to be successful, we actually need to understand the speculative assets that we're actually getting into, and the wild, wild west that we call cryptocurrency, guys, because I intend to make it in the crypto world. I don't know what the market's going to do. I can just look at past data. I can analyze. I can ensure that my portfolio has got the biggest possible chance of success by having that allocated diversification. So if you want more videos like this, guys, and if you did find this interesting, let me know in the comments. Join the Discord group, guys. That's where the alpha happens, completely free, and I'll see you in the next one.